Great. So who is Emerge180? Just a brief overview of us. We're licensed tax professionals, includes enrolled agents, CPAs, tax attorneys. What we're talking about today, the employee retention credit, we've actually been specializing in tax credits long before the pandemic hit and before they created this employee retention credit, primarily with work opportunity tax credits and R&D credits for small businesses. We've been doing this for a long time, 20 plus years in business, and we are primarily focused on that small to medium-sized business community. So I'm going to give you a brief overview of the history of the employee retention credit. It was actually created in the first stimulus package way back at the beginning of 2020. And as additional stimulus bills have been passed, they've made changes to it along the way. Really, the primary stimulus bill is the one that was passed at the end of December in 2020. That really changed the landscape for the employee retention credit. And what that did was it did essentially three things. Number one is it said that was the stimulus package that said you no longer have to choose between a PPP loan or an employee retention credit. You can now get both. So that was huge. The second thing is they said we're going to allow businesses to go back in time, retroactive to March 12th of 2020, and capture the credit. And then they extended the credit in through 2021 and also increased the value of that credit. So as you can see, this is in 2020, that max credit was only up to $5,000 per employee, but that has increased up to $28,000 per employee. And we're going to go into more detail about how you qualify and the ways that you qualify here on the following slides. But this is available in conjunction with PPP loans. This is cash back, real cash back to your business, not a credit against future taxes. You will literally get a check in the mail. It's not a cliche. You will get a check in the mail from the IRS for these funds. So here's a couple of examples. These are live examples. So far, I would say that our clients, we started doing this in February, submitting these, and our clients, we probably have received over $10 million at this point through this program. And there's money going out every day. In fact, I just heard from a physician just this morning who was excited because he got 2 checks in the mail through this program. So, but here's a couple examples of what we're talking about. There's we have as large as 702 employees. It's a healthcare entity, and they were eligible for the first 2 quarters of 2021. They received nearly $5 million through this program. So, but they also had received a PPP loan in 2020. They weren't eligible for a second PPP loan. Those of you on or may have listening have had 1 or 2 PPP loans. And this company was not eligible for the ERC in 2020, but they still were able to receive close to $5 million. The second example is a restaurant, 63 employees. The amount of money they're getting through this program is $635,000, and that's just through the second quarter of 2021. And this company also received 2 PPP loans. So not only did they get both PPP loans, they're getting another $635,000 through the ERC, which is just tremendously helpful for that business. And then on the other examples is much smaller. It's a private school with 8 employees, and they're getting $137,000 through this program, and they also received 2 PPP loans. So these are actual live examples just to give you kind of a feel for the amount of money that's available through this program. I will tell you this, in our experience, over 90% of the companies that we're working with actually are getting more money through the employee retention credit than they did get through their PPP loans. So it's that significant of a program. And this is real money, real cash back into your pocket that that's going to help you in however you see fit. So we're going to go over some basic eligibility requirements. So in 2020, you had to have 100 or fewer full-time employees, and you had to have what's called paid qualified wages between March 12th and December 31st of 2020. Now I'll go over what qualified wages are in a following slide. In 2021, they increased that to 500 and fewer full-time employees, and then they evaluate qualified wages on a calendar quarter basis. So you may be asking, hey, Jonathan, just on the previous slide, you said, hey, there was a company with 702 employees. How were they eligible when they had more than 500? Well, here's why, and there's a note here at the bottom, is how you're able to define what a full-time employee is. And this is one of those things where it's a real good benefit for a business. So the IRS, by regulation, defines a full-time employee as someone who works 30 plus hours a week or 130 plus hours a month. So that's the difference between part-time and full-time. Now, here's what's great about this program. All of the wages and all of the people that you employ on a part-time basis go towards the amount of your employee retention credit. So you get the credit for those wages that they paid, but they do not go against your employee count. So that 702 healthcare company, they had about half of them were considered part-time, the other half were considered full-time, and therefore they were eligible for the program because of that qualification. So in that instance, we actually went through on an employee by employee basis, identified which employee was part-time, which employee was full-time, and we were able to qualify them. Another example where this is important is we had a company out in California who's went to their accountant. Their accountant said, "Hey, you have too many employees." Well, when we did their review of the hours that they worked and so forth, we were able to qualify them for both 2020. They had about 120 employees. Well, when we did the evaluation, 80 of them were full-time. The other 40 were considered part-time. We were able to qualify them for 2020. That was a difference of almost $500,000 for that business. So it's important to know that, hey, your part-time people don't go against your full-time count, but they do contribute to their wages contribute to how much you're going to get on this. Some other basic eligibility requirements. Tax exempt organizations are eligible. We've helped a lot of charities. We've helped from Girl Scouts to churches. We're able to get those, they're eligible for this. Employers in US territories are eligible. So if you're a business and you operate in Puerto Rico or the US Virgin Islands or any of those, you are eligible for this as well. Now, a couple things are, if you're self-employed, 1099s aren't eligible for this. You have to pay with W-2 wages. This is not independent contractor or 1099. These are wages that are reported to the IRS on a standard payroll tax return, such as a 941 or 944. Another thing is that businesses that open prior to December 31st, 2020 are eligible throughout 2021. So, and I mention this because there's a lot of government programs where they have different start dates and so forth. Some of you may have had experience in terms of PPP loans where their start dates are different. If you've got an SBA, what they call the disaster loan or an EIDL loan, like you had to be in business prior to March 11th to be eligible. So there's a lot of eligibility dates floating out there with all the different government programs. For this one, it counts about when you started your business and paid those wages. So even if you started in December 31st, or you start in the beginning of 2021, you are eligible for wages that you pay as part of this program. And also we get asked this question is like, well, what about the acquiring business? The acquisition time period does not affect what you're eligible for. So if you sell your business during this time, you're still eligible for any wages that you paid in which you qualify for the program. And if you purchase that business afterwards, you're also eligible for it. So that does not impact the value or the ERC program for you. Okay, there's a lot of information on this slide, so I'm going to spend definitely a few minutes going over this. There are 3 ways to qualify for the employee retention credit. I talked about eligibility. There's basic eligibility requirements in order for the program. Once you're eligible, or we've deemed you eligible, now we have to qualify you. Okay, now there's 3 ways to qualify you. There's the decline in gross receipts. There's what's called a government suspension order. And the newest one, which was just released in August, was called this recovery startup business. Now, the good thing about the employee retention credit is that, you can qualify for the program with more than one of these categories. So it's not like you have to pick one and you only qualify under one category. You may have had a decline in gross receipts and be under a suspension order. We can use those both to maximize or extend the time period of which you qualify. So I'm just going to go down in just a little bit here on these slides. So a decline in gross receipts, what we're talking about here is your baseline year is 2019. What I mean by that is whether you're looking at 2020 comparison or a 2021 comparison, you're comparing that to 2019. You're not comparing 2021 to 2020. Everything's compared against 2019. And it's evaluated on a calendar quarter basis, specifically a calendar quarter basis. And it has to be the same quarter. So when you're looking at the first quarter of 2021, you're only looking at the first quarter of 2019. It's a direct comparison against that same quarter. Now, in order to qualify under a decline in gross receipts, you had to experience a 50% decline in 2020 compared to 2019. And then they relaxed that requirement significantly so that it's only a 20% decline in 2021 versus 2019. And we've worked with several businesses that, they were eligible. We reviewed their Q2 and Q3 of this year against their 2019 numbers, and we're able to qualify them under this decline in gross receipts. Okay, now this is valid from March 12th of last year through September 30th. The Infrastructure Act that was just passed last month changed, they eliminated the fourth quarter qualification for both the decline in gross receipts and the government suspension order. So what you're seeing, this presentation includes the most recent IRS guidance that was just released on December 6th that outlines the Infrastructure Act that was passed. So these dates are accurate per the most recent IRS notices. The second way to qualify is what's called a government suspension order. And this could be at the federal level, state level. It could be a local level, which could be a municipality, could be a county, could be your city, whatever it may be, but it's an order that partially or fully suspends the operations of your business. Now, this is a very gray category. So in a following slide, I'm going to go into much more detail on this. But really the bottom, it must limit commerce, travel, or group meetings. And it has to be set for during a specific time. And this varies significantly by state and by county. I can tell you, we're in Florida, and the local orders for Tampa, where I'm based at, are much different than they are for other parts of the county. Like there's Charlotte County down south of us. Their suspension orders ended last September. Well, the suspension orders in Tampa or Hillsborough County, which is the county I'm in, they ended on May 4th of this year. So there's a lot of variance. So it's you need to know what orders are in place and really how they impact your business. So this qualification also goes from March 12th of 2020 through September 30th of 2021. Now, the third way to qualify is also the newest way to qualify. It's called the recovery startup business. And this is really for anyone who opened up a business after February 15th of 2020. Now, let me be clear on what they mean by open. So you may have created the entity prior to that date, but when you became fully operational, that's when the start date occurs. So it's when they basically say when you begin operating as an ongoing concern, right? So so you may have started the entity in 2019, but did not start full operations till after February 15th. You are eligible under this program. The other thing about this is that there's a requirement that you have under $1 million in average annual gross receipts. This is really geared towards small businesses that started after the pandemic began. And so this is also it's only valid, this qualification is only valid for Q3 and Q4 of 2021. You can't qualify under this category for any other time periods. And the other thing about this is that it's maxed at $50,000 per quarter. So for a total of $100,000. And for the fourth quarter of this year, which we're in now, it's the only way to qualify for the program because, like I said, the Infrastructure Act passed last month, canceled the fourth quarter for the other two ways to qualify. But if you're a recovery startup business, you're still eligible for Q4. The other thing that they say is they use this category as long as you're not eligible for, you don't qualify under a different decline in gross receipts or a suspension order. The reason why is you'd rather use the money, you'd rather be able to not have that cap of 50,000. So if we're able to qualify you under a different way, it's primarily for Q3, it could be more money in your pocket. Now, what I said at the beginning is you're allowed to combine these in a number of different ways. You don't have to pick just one. So there's a lot of companies that we've qualified under a government suspension order for 2020 and maybe part of 2021, but then we've qualified them under a decline in gross receipts through the end of the third quarter, significantly more money in their pocket. Same thing with, we've combined, ones that started after February 15th, we're still under a suspension order. We've qualified them throughout the process, and now they're eligible as a recovery startup business for the last half of 2021. So that's important to be able to know all three of these and which dates apply to which way you qualify for the program. Okay, so I wanted to go into more detail about what we mean by partially suspended operations. So really, this is talking about any business where a government order reduced the capacity and/or hours of operation. It's considered partially suspended. Now, this primarily applied to, restaurants, hospitality, retail, medical facilities, so on and so forth. But it also talks about any entity not able to hold meetings or meetings are limited. So it applies to, we had capacity issues in terms of churches or, faith institutions, but also any place where there's meetings being held, right? We've qualified private school organizations where they had limitations. So it's about really understanding the guidance that the IRS released about this and how to qualify for the program, because it is a pretty broad category. Now, a couple other things is that, businesses that rely on suppliers that are partially suspended, they do have a downstream effect where that business is also eligible. So if you weren't partially suspended, maybe you're a retail or a wholesaler, but your suppliers were all affected by this, and that impacted your business, there's a good possibility you qualify under a suspension order. Another way is that multi-purpose businesses, if one part is partially suspended. Let me give you that restaurant example, right? So a restaurant, they said, hey, we do catering, we do takeout, and we have, in-house dining. Well, the takeout increased over the pandemic, and their catering stayed the same, but they're eligible for their entire business because up until where they're able to have full capacity within their restaurant, their entire business is eligible. This also applies to, medical business, practices. They may have where part of the business had elective procedures and part of the business had, was, direct healthcare. Well, as long as one of them was under a suspension order or had the capacity limited, the entire business is eligible. Another thing that we talk about is a multiple location business. So you have a business, but you have more than one location. Well, as long as one location is under a suspension order, it applies to all of these locations. I'll give you a perfect example. We were working with a faith organization that had 10 different locations. About half of those, maybe 2/3 of those locations were not under any suspension order based on they were located, but a couple of them were. So it applied to the entire organization, not just the locations in which the suspension order was in place. And I can go through many examples, or if you have specific questions, I can tell you this. Typically what we do when we're working with our clients is we're taking them through this process. we're looking at any state or local orders that limited capacity because it is highly variable, and then qualifying them based on that information. Now, if it still comes down to like you're just really not sure, the IRS in their infinite wisdom put together what they call this comparable operations test. And really they looked at 4 factors. The cliff notes of this is they help you evaluate how easy it was for you to transition from an in-office environment for your business to an at-home environment for your business. Now, a couple things is, if you did modify your business, it doesn't mean you're eligible. So you could have had orders requiring modifications, signs, plexiglass, whatever. That doesn't make you eligible. And also, if you voluntarily suspend operations, we had several restaurant clients who continued to limit their capacity because they thought that was in the best interest for them or for their patrons. But if there was no order requiring it, they're not eligible. Now, one other thing that's not on this slide that I do want to make note of is the IRS is very clear that the order does not have to be enforced or enforceable in order to be eligible for this. So, just because there's not the pandemic police going around saying, hey, you stayed open an extra hour or your capacity exceeds what you're allowed, that does not matter. As long as that order is in existence, you're eligible for the program. So, and I'll be happy to answer more questions on this specific topic, but like I said, it is really an evaluation of a case-by-case basis. There are categories of businesses that are much easier to qualify. I've mentioned a couple of them and just previously, but each business it's worth looking at this directly. All right, so I also talked about qualified wages. Like, what are qualified wages? Well, they use this term as how you define per employee the amount of that employee retention credit for that individual. Now, in 2020, they look at what's called $10,000 of qualified wages. And qualified wages include the gross wages, not the net, the gross wages paid to the employee. It does not include the employer's contribution of taxes, whether it's Medicare taxes or Social Security taxes. It doesn't include the employer's portion of that, just the straight gross wages. But it does include any portion that the employer contributes to their retirement or any group health plan. Now, for 2020, they looked at, in order to maximize this, you needed to have $10,000 in qualified wages from March 12th to December 31st, over that broad of a period of time. And then they'll give you 50% credit up to $5,000. Now, this is prorated. So if you had $8,000 in qualified wages for a person, then you're going to get 50% of that, or $4,000. So you do get a prorated amount for each employee. Now, in 2021, they're looking at $10,000 in qualified wages on a per calendar quarter basis. So just specific to that individual quarter. And they're giving up to a 70% credit of on that 10,000. So that's where we come up with, it's a $5,000 per employee max for 2020, and it's a $7,000 per quarter max for 2021. Now, I didn't mention this previously, but we do get asked this quite often, is you don't have to have the same number of employees that you had when you started this. This is not, even though it says retention credit, they're not looking at any like retaining those employees. So you could have people that started after the pandemic started. You have people that have left during it that are no longer employed with you. But if you qualify for the program, even if they're no longer there, any wages you paid during that time period to that person, you still get the benefit of that towards your employee retention credit. So that's another way of, like, they're not really looking at the number of employees you retained. They're really looking at the wages that you paid out during this time period. So they're looking at it as like, hey, you contributed, your business kept these people employed, you paid them wages. We want to give you part of that money back, during the pandemic time period. Now, there's no double dipping, and what I mean by that is you can't use the same qualified wage towards both your PPP forgiveness or any other program and for the employee retention credit. And there's a slide at the end that I'm going to talk about PPP loan forgiveness and how to look at that through the lens of the employee retention credit, because there's some benefits to doing things certain ways that put more money in your pocket. And likewise, if you use wages for the employee retention credit, you can't use those wages on your PPP forgiveness. There's other, like the shuttered venue is another program. The restaurant revitalization fund is another program, which those are the primary ones that I'm referring to. Now, I do want to, there's a note here at the bottom. It talks about what's called eligible employers. And there's a lot of IRS language and documentation on what an eligible employer is. Well, let me just cut to the chase on this. Basically, what they're saying is, qualified wages only apply to what's called an eligible employers. Now, if you're a family-owned business, that only applies to you and your significant other. You can't get this, you can't hire all your nieces and nephews or all your siblings, pay them all this money, and then apply for the employee retention credit and get that money back. Qualified wages for this program do not include owners, family members, or extended family members. Just the owner and significant other, if that significant other works in the business. So we have a restaurant. It's like, I swear they had like 15 relatives all working in there. And we had to say, hey, sorry, there's only 2 of you that we can actually use these wages for. Okay, so there's a couple ways to claim the credit. You can claim it on your original payroll tax return. So they've updated all of those forms to include how to do that. And that's typically the best way to do that in terms of accuracy, and then expediency. Excuse me. The way that we mostly apply for it, though, is through what's an amended payroll tax return. Obviously, most of has happened in 2020 and the first 3 quarters of 2021. So pretty much all that we're doing right now is through amended payroll tax returns. You can also request an advance in the current calendar quarter. That really is coming to an end at the end of this year. And you can reduce or eliminate your current federal tax deposit. The caveat to that, and if you do have questions in terms of like how Q4 is affected, really that advance now and then eliminating or reducing your tax deposits, that only applies to businesses that qualify currently as a recovery startup business. Now, time-wise, it's important to know how long does it take the IRS to process these? Well, the IRS, and this is probably one of the downfalls of the program, the IRS is not moving quickly on this. The PPP loans were great because they got money out to businesses fast. It was very, fastly implemented, and it was implemented through all that large network of lenders that the SBA had access to. Here, we're just dealing with the IRS. They're not partnering with any lenders. They are processing all of these on their own, and it's taking them a while to get through them. What we're seeing is you file on the original return, you're looking at anywhere from 2 to 5 months for you to get that money back. On an amended payroll tax return, we're seeing 6 to 9 months for this to take. So our clients that we started processing these in February, March, and April, they started getting their money August, September, so on and so forth. If you request an advance that is pretty rapid, like I said, it may be not relevant anymore because we're coming to the end of that. And certainly reducing or eliminating your federal tax deposits, the most immediate way to put cash flow back into your business. But we walk through each of these with our clients to make sure if it is relevant, that they pick what's best for them. So just in general, this is how we handle the process. So each client goes through a detailed eligibility and qualification review. And that includes both the basic eligibility requirements that we went over, but also how do you qualify, or that combination of how you qualify in order to maximize the amount of the employee retention credit. Then we just gather payroll data. We don't need to know tax returns or anything like that. We look at your payroll data to determine the amount of the ERC. Now, we will ask for gross receipts by calendar quarter to see if you qualify under that. But once we just get those raw numbers, we don't really need to look at all of your profit and loss statements or tax returns or anything. All we need is payroll data. So if you have whether you do your own payroll or whether you have a payroll company, typically that information is very simple to get to. It's gross wages by employee over specific periods of time, and then the applicable payroll tax returns. Now, I will tell you that if you are in a PEO, okay, and if you don't know what a PEO is, that means you're probably not in one. But if you are in a PEO, professional employer organization, where you basically lease your employees from someone else, and you primarily do that for benefits and so forth, you are still eligible for the employee retention credit. We just have to go through your PEO in order to capture that. So if you are in a PEO and you have questions, we certainly can take this offline and we can go into more detail. So once we've made our determination on the amount of the ERC, we complete all of the applicable IRS documents. That includes the amended returns, but it also includes all the backup documents. It includes the worksheets and the spreadsheets that are all as well that go into that. And then we submit everything on behalf of our clients to the IRS. We send everything needs to be sent in certified, confirmed receipt. You need to be able to prove that the IRS received it and know exactly when they did receive it. We follow up with the IRS after submission. One of the things that we do is we get what's called an 8821 that allows for us to check on those status and also answer any questions that the IRS may have as part of this process. And then really you just wait and receive the funds. You wait, you will get a check in the mail for the amount. It just may take a little time. So just a basic overview of the program. Now, the max potential credit is up to $33,000 per employee. And that's really through a combination of all three programs that you would have to be eligible for. So it would be very unique that you actually get close to that. But I will tell you, on average, our clients are seeing anywhere from $12,000 to $15,000 per employee in the amount of the employee retention credit. Now, this is real cash back for your business. This is not a credit against future taxes. This is real cash. It's a check made out to your business that you receive in the mail. Obviously, there's flexibility on receiving advances or reducing your tax deposits, but that's really coming to an end. Now, there's no income tax implications on this. Now, we can walk through the accounting of this because you're not paying taxes on the amount you receive, but it does lower your employee costs for when you do that. And that comes into how you're accounting, how you do your own internal accounting. Now, some of the things I like most about this is that there's no forgiveness process. Once you get that money back, there's nothing you have to go through to make sure that you don't have to pay it back. It's yours. How they're looking at this, I tell people, think of this more like a refund than an actual credit, right? So this is a refund. There's no forgiveness process that you have to go through to keep that money. The other thing I really like about this is that there's no requirements on the use of proceeds. Many of you had the PPP loan. There were strict requirements on how you could spend that money. Once you get this money back from the IRS, you can do whatever you want with it. You can give it back to the employees. You can go on a vacation. We have many companies that are using this to expand their business or open a new location. You can do whatever you want with that money. No requirements on it. So the other thing about it is it does have the ability to offset previous year's tax burdens. And what I mean is if you got behind in previous years, you can use this to eliminate payroll taxes that you might have owed previously. You may have helped several clients in that situation actually, alleviate that stress. Nobody really wants to owe the IRS money. It's not something, you want to do. This is a program that could really help get you out of that. And just in conclusion, it's just we handle the entire process. So that's a good summary of it. And certainly we can go into more detail for additional questions.
Can I ask a question?
Absolutely.
I have several questions actually. You mentioned that only restaurants qualify or retail shops qualify also?
Retail, actually we've qualified tons of different businesses. I was just mentioning restaurants is like a common one
Right.
that qualifies because of like the suspension orders. Everyone knows about limited capacity in restaurants.
Right.
But it also, this applies, and we've helped so many different types of businesses. It just, so most businesses that, you wouldn't think necessarily qualify, we've helped. We've helped insurance agents. We've helped medical. We've helped people that are involved in construction. We've helped certainly a lot of restaurants. We've helped nonprofit organizations. So it's a very broad number of businesses that we've helped.
But like clothing shop, would that qualify, you think?
Well, so we will take you through an eligibility. So the first thing is, how many employees did you have and did you pay wages during that time period? All right. So if you meet those eligibility requirements, then we take you through the qualification, and we would look at what, if there was an order, a government order in place that limited the capacity or the operations of your business.
Now, that's what I'm asking. Yeah.
Yeah. So I don't know specific to your case, because I don't know every local or state's order, off the top of my head. But I would say in general, most retail locations do qualify at least for part of this time under a suspension order. And then we also look at, okay, did you have a decline in gross receipts? See if you qualify for other periods for that, which is a good possibility that you did. And then when did you start your business? Because if you started after February 15th of 2020, then you qualify under a recovery startup business. So we look at all of the different ways. And like I said, it's a case-by-case detailed review for each company.
Okay. You said 5,000 per year per employee. It is for the whole year. It's not for the per quarter, right?
So in 2020, this is just how they passed the stimulus bills. So when they passed the stimulus, the first one, the amount of it was only $5,000 for all of 2020, or from March 12th to the end of 2020. So it's easy to qualify to max that out with the 10,000 in wages. But in 2021, they increased the amount of that to be up to $7,000 per quarter. So it's worth way more money in 2021 than it was in 2020. Now, I don't know the inner mechanics of why they did that, other than it's just a very good benefit to businesses.
Right. Are there any deadline to file this 941X?
So it's a great question. And I didn't address this. It does come up frequently, though. So the program is concluding on December 31st of 2021. That just means the time period of which it exists. However, in the second stimulus package, you normally have what's called 3 years to from the due date to file an amended return and get any benefit from that amended return. So if you're owed money, this applies to whether it's your personal income tax or anything. If you amend a return and there's money that's due back to you, you have 3 years in order to amend that return and get the money back. For whatever reason, they extended that to 5 years for this program. So we could be literally 5 years from now reviewing a company and submitting an amended return for their benefit for this specific credit. Now, they may change that back to 3 years at some point in the future. The advice I give is like, start it now, because the sooner you start the program, the sooner you're going to get the money. But you do have up to 5 years to actually amend the returns to get the benefit of this program. It's a very unique IRS caveat that they added on this one.
Yeah. I did one restaurant. That's why I'm asking all these questions. And I'm not sure it was right or not, but we mailed it out. It will come back, I'm sure. So you said
so you did it for a client of yours?
Right.
Yeah.
Yeah. So it says you said 50% decline in gross profit, or
well, gross receipts, not gross profit.
Yeah, gross receipts. Yeah, gross receipts, or it's closed by government order, right? It doesn't have to be both, right?
It doesn't have to be both. It can be one or the other, and you can combine them over different periods. Like they could be for a suspension order in 2020, but they could have a decline for 2021. So you can really mix and match the ways to qualify them.
For 2020, if family members are working, can we include them, owner and family members, for 2020 filing?
Basic eligible employer regulations apply to this program. So the best thing I would do is just reference eligible employers and use that as the base for any calculation that you're doing.
No, but what I'm saying is when I do the calculation, should I include the owners and his family members to include in the gross?
That's, my answer is the same, basically, is you have got to go off the IRS eligible employer regulations, right? Which means like if extended family members and family members and extended family members are not considered employees that are eligible, not just for the employee retention credit, but they're not eligible for other tax credits that you can get through the IRS.
Okay, but for 2020 was the same rule?
Correct.
So
The concept of eligible employers has been around for decades. It's something that the IRS has addressed for decades, and they just said it applies to this program, not for the entire program, not any specific year, the entire program.
Okay, so for 2020 and 2021, owners and relatives are not included, and that's what I'm hearing?
No. We can go over the specific. I don't know. I want us to go down a rabbit hole on eligible employers, right? So, because it's not as simple as to simplify it, an owner or a part owner or whatever it is, and their significant other, if they work in the business, their wages are qualify for the employee retention credit. Any other family members or any other extended family members, their wages are not considered qualified wages and do not go towards the employee retention credit.
Okay, got it. Yeah. I think, and everyone got that right before the PPP loan receipt, everyone got the $1,000 per employee or something like EIDL or something like that from SBTC.
Well, there was the EIDL grant.
Right.
That was up to $10,000.
Right. Right. Is it included? Should we include that in the as a PPP loan?
No.
No. Okay. Okay.
No, that's not something that goes through a loan forgiveness process. That was just a grant.
Okay. I got it. Thank you so much.
Sure. So I did want to touch on just the PPP loan forgiveness process. And we've helped a lot of businesses just, with this to make sure that they're maximizing it. And these are just highlights, right? So, and they very much simplified the process. I'd actually have to commend the SBA and so forth. So really, if you have under 150,000 and your lender worked with the SBA, they've streamlined the forgiveness process. But it's important to note that it's a 60% is all you need to spend on payroll expenses in order to get 100% forgiveness. And this is important, right? Because it frees up wages that you could use towards your employee retention credit. The other thing is, there's that $150,000 is the difference between what they call a simple application or a regular application. So if you got more than 150,000, there's a little bit more stringent requirements on your PPP loan forgiveness packet. Now you do have up to 10 months after the end of the covered period to apply for the forgiveness. Not a lot of people know that they have that much time in order to get the forgiveness. Now I mentioned that you can't double dip. So payroll expenses for PPP are excluded. We recommend that you maximize your non-payroll eligible expenses for your PPP forgiveness. That's like your rent and some other things. Make sure you document that and include that in your loan forgiveness so you free up those wages for the employee retention credit. You want to be close, you want to be at 60% is really the magic number in order to get the entire forgiveness. And the reason why I'm saying this is because you can see a bump of sometimes 10 to 20% increase in the funds you receive through the ERC by using this approach, as opposed to say, hey, I've used all wages, it's easier from the PPP forgiveness standpoint. You may be leaving money on the table that you could get through the employee retention credit.